Hello, welcome to Financial Markets Weekly, an audio podcast by Succinct Information. This is a professional summary, free of noise, focused on facts, and straight to the point. We help you save time while covering the key events and market performance. These are the highlights from last week.
The equity market sell-off accelerated last week, as the risk of an escalation in the Israeli-Palestinian conflict increased. Bond yields reached a 16-year high, and corporates issued mixed profit guidance. Economic data was largely positive, with the US economy expanding rapidly during Q3, and PCE inflation remained stable in September. Several mega-cap technology and communications companies reported quarterly results that exceeded both top and bottom line estimates, but a pessimistic outlook issued by Alphabet triggered a significant decline. Back to this topic in a minute. In monetary policy, both the European Central Bank and the Bank of Canada kept their respective benchmark interest rates unchanged, and signaled they would maintain them at restrictive levels until inflation fell and stayed at their targets. The ECB, in response to the ongoing disinflation process, broke its longest run of hikes in 25 years by leaving its interest rate steady. The deposit rate at 4% and the refinancing rate at 4.5%. The ECB noted the weakness in the Eurozone economy, with poor industrial and services figures, though it also highlighted the resilience of the labor market. Canada kept its policy rate at 5%, the highest level in decades. The current restrictive stance has helped control inflation, but has had an impact on slowing economic activity. In economic data, US GDP surged by 4.9% on an annualized basis in the third quarter, surpassing expectations and dispelling recession scenarios. This growth was driven by higher wages, resulting from a competitive employment market which fueled personal consumption. This expansion marked the fastest growth in nearly 2 years. On the inflation front, personal consumption expenditures, or PCE, which is the Fed's preferred inflation measure, rose by 0.4% month-on-month, and 3.4% year-on-year in September, matching August's increase. The core PCE reading increased by 0.3% and 3.7%, slightly lower than in August. These data reflect the strong health of the US economy and stable inflation. The DXY dollar index saw a modest rise, mainly gaining ground against the Swiss franc and Canadian dollar. Gold experienced 3 consecutive weeks of gains, breaking the $2,000 mark for the first time since May. This surge was largely driven by concerns about an escalation in the conflict in Gaza. In interest rate markets, benchmark bond yields finished the week marginally lower, but 10-year US Treasuries briefly traded above 5%, marking the highest level in 16 years. It closed at 4.85%. German bonds closed at 2.84%, and UK gilts at 4.55%. In commodities, WTI oil saw a 3.6% decrease, closing at $85.50, while Brent was down by 1.8%, ending the week at $90.50, in a volatile week for trading. Market behavior was influenced by updates in the Middle East conflict, which included mediation talks facilitated by Qatar, and a US attack on Iranian targets in Syria. Back to stocks. US benchmark indexes experienced notable losses, driven by mixed corporate outlooks during a busy week for quarterly earnings announcements. The S&P 500 and the Nasdaq Composite fell 2.5% on the week. The Dow Jones Industrials and the small-cap Russell 2000 indexes are now in negative territory for the year, while the S&P 500 and the Nasdaq Composite still show positive returns. In Europe, the broad Stoxx 600 has remained almost unchanged year to date, with Italian stocks as the best performers. Several mega-cap technology and communication stocks reported results. These include Microsoft, Amazon, Alphabet and Meta Platforms. Although all beat top and bottom estimates, guidance for the next quarter sent Alphabet's stock down by 10% and Meta's by 4%. There were significant moves among other megacaps. JP Morgan fell 5% after CEO Jamie Dimon announced he plans to sell 11% of his holdings next year, his first cash out since becoming CEO. Exxon also fell 5% after missing net income estimates. In European markets, some notable movers include a 52% weekly plunge for French fintech, Worldline, after it cut full-year guidance, on the back of a steep slowdown in its biggest market, Germany. Siemens Energy, the German-Spanish renewable energy leader, fell 31% to its lowest price ever, after it was forced to request government guarantees worth €15 billion. Finally, Sanofi, the French pharma giant, lost 17% last week when it announced a lower profit outlook, and a focus on long-term results at the expense of short-term profitability. A few bullet points to complete this episode. In corporate deals, Chevron is acquiring Hess Corp in an all-stock deal worth $53 billion, to become the country's second-largest oil and gas company. Also, in the software sector, Engage Smart was acquired by private equity firm Vista Equity and General Atlantic for $4 billion. In IPOs, Kokusai Electric, a Japanese semiconductor equipment company, was listed on the Tokyo Exchange and became the country's largest IPO in 5 years. It raised $724 million, shares rallied 45% to a market value of $4.1 billion. In the digital assets space, Bitcoin took the lead with a 15% weekly rise, propelling the entire crypto space to higher levels. The rally was attributed to headlines anticipating an approval of spot ETF applications before the SEC by several asset managers over recent weeks, generating optimism. The week ahead includes the Bank of Japan's policy meeting on Monday, the Fed on Wednesday, and the Bank of England on Thursday. On Friday we get the latest employment report from the US Labor Department. It will also be an active week for earnings reports, including blue-chip names such as Apple, Berkshire Hathaway, McDonald's, Caterpillar, HSBC, Toyota, Pfizer, Airbnb and BMW. That's all for this week. Please subscribe to the channel and help us promote it. Visit succinct.info to learn more about our subscription.